Hello and welcome to Mirror Accounting Channel, where we educate and entertain on investing, finance and accounting. As always, please remember to like, share and subscribe. In today's video, I will be looking at capital gains tax. Thanks for joining me and let's get into it. Capital gains tax is an important part of the U.S. tax system, affecting individuals and businesses that profit from the sale of assets. It applies to investments such as stocks, real estate, and businesses. This video will explain what capital gains tax is, how it works, its implications for taxpayers, and potential changes to capital gains tax rates. What is capital gains tax? Capital gains tax is a tax imposed on the profit made from selling an asset. The gain is calculated as the difference between the purchase price, also called the cost basis, and the selling price. The tax applies only when the asset is sold. Until then, any gains remain unrealized and untaxed. Types of capital gains. Capital gains are categorized based on how long an asset is held before being sold. Short-term capital gains. These apply to assets held for less than 1 year and are taxed at ordinary income tax rates, which range from 10% to 37%. Long-term capital gains. These apply to assets held for more than 1 year and are taxed at lower rates, typically 0%, 15%, or 20%, depending on the taxpayer's income level. For 2025, capital gains tax rates for single tax filers are 0% for taxable incomes up to $48,350, 15% for taxable incomes up to $533,400, and 20% for taxable incomes over $533,401. For 2025, capital gains tax rates for married taxpayers who file joint returns are 0% for taxable incomes up to $96,700, 15% for taxable incomes up to $600,050, and 20% for taxable incomes above $600,050. How capital gains tax works. When an asset is sold, the seller must determine whether the gain qualifies as short-term or long-term. The tax rate applied depends on how long the asset is held in the seller's income tax bracket. Exemptions and reductions. Certain situations can reduce or eliminate capital gains tax liability. Primary residence exemption. Homeowners may exclude up to $250,000, $500,000 for married couples, capital gains when selling their primary residence if the house was their primary residence for 2 of the last 5 years at date of sale. Homeowners can only have 1 primary residence at a time, but the 2 years don't have to be a consecutive, single block of time during the 5 years. This exclusion can only be claimed once every 2 years. Retirement accounts. Gains from assets held in tax-advantaged accounts, such as IRAs and 401k, are either tax-deferred or tax-free. Tax loss harvesting. Investors can offset gains by selling losing investments, reducing taxable income. Impact of capital gains tax. Capital gains tax affects investment decisions, retirement planning, and economic behavior. Investors often consider tax implications when buying and selling assets. Proposed changes to capital gains tax rates can also impact market trends and economic growth. Potential changes to capital gains tax rates. President Donald Trump's Big Beautiful Bill, passed by the House and being debated in the Senate, has no proposed changes to capital gains tax rates. If the bill is signed into law in its current form, capital gains tax rates would remain unchanged. Recommended actions for investors. Tax diversification. Spread investments across different account types. Utilize tax-advantaged accounts. Consider municipal bonds and tax-efficient investments. Proactive tax management. Monitor proposed legislation. Consult with tax professionals. Review investment strategies regularly. Conclusion. Understanding capital gains tax is essential for investors and property owners. By knowing the tax rules, exemptions, and strategies for minimizing liability, taxpayers can make informed financial decisions. Keeping up with legislative changes is crucial to adapting to any future tax policy shifts. For the latest updates on tax policies, stay up to date on financial news and government announcements. Disclaimer. Tax laws are complex and subject to change. Always consult with a qualified tax professional for personalized guidance. This brings us to the end of today's video. We hope you learned something from the video. As always, remember to like, share and subscribe, and I will see you in the next video.